Hello and welcome to this week's edition of the Fit Finance Sessions with me, Henry Elliston, Tim Webb, and Tom is back from sunny Crete, and the sunburn seems to have receded in our gloriously hot, sunny British climate. Thanks for joining us today. We're going to talk about discretionary investment management, the pros and the cons. And just to introduce you to the concept, this is of course a concept we use with many of the portfolios that we manage at Efficient Portfolio. The principle behind it is that we hire in who we think is a professional investment manager to look after the funds held within our pension, in our clients' pension and investment portfolios. And those investment managers hold discretion over the accounts. So they're free to pick and choose within boundaries that we put out at the beginning, such as the risk profile or whether or not it should be an ethically balanced or a passive or actively balanced portfolio. So we set the guidelines and then they're given discretion to invest the client's money as they see fit, to try to make the money grow as well as possible in the most cost-effective way. And as I say, within those parameters that we set out to begin with. So what we thought we would do today, Tim is going to take the cheery job of guiding you through some of the benefits of using a discretionary investment manager. And Tom Scrooge, that he wasn't at Christmas, is going to take the negative role, the other side of the coin, and he's going to talk us through some of the drawbacks of using a DFM or a DIM, as they sometimes know. So Tim, take me away. What are the great benefits of using a discretionary investment manager as opposed to not using one?
Yeah, sure. So I suppose rather thinking quite selfishly, I suppose, from a financial planning angle, having somebody to perform the specific function of the investment management of your wealth then allows your financial planner to actually do their job a little bit better in terms of remaining in that bird's eye view and, arguably looking at the other more wider financial aspects to do with being a financial planner, such as tax planning, income strategies and what have you, because doing an investment management role specifically, would take up an awful lot of time. So therefore, one could argue that it'd be taking some time away from those other all important aspects of the overall picture. But also one of the other ones which most people tend to appreciate is the time delay, which would be there if the discretionary manager didn't have discretion over your money insofar as making changes in the portfolio. So let's say they were in fund A and decide that fund B or fund C would be a better option for you, according to your risk profile and all the rest of it. They can make that change without your say so, because you've signed a mandate to give them the powers to make that decision for you. Whereas, as we'll hear from Tom later on, the other side of the coin, actually there can be a bit of a time delay between that decision actually going through to trading and changing the portfolio and what have you, and the market can move on. So it's far more efficient in that perspective, in that changes can be made as and when the managers see fit. So yeah, they're the main ones. I mean, I suppose from a side perspective, professionalism, you're employing professionals in the investment space to do what they do best, and to work off the mandate that you've prescribed for them, rather than having to do things yourself, which you may not be as educated clearly as somebody who's spent half a decade or a decade of their life plus studying that sort of stuff. But I think we'll hear a little bit later about sort of the idea of self-selecting, because there is this, I don't know if you guys have come across it, but there is this sort of uprising of the DIY investor. I don't know if you've come across any articles on that from that angle, but yeah, this idea that people can just invest themselves and you don't need or shouldn't be paying for professional investment management. But yeah, so they're the main.
I think it's really right, Tim, especially that first bit that you were saying about being able to make quick changes. And especially, I think in two senses. One, when we saw, in April last year, when the market moved very, very quickly, of course, the DFM has that opportunity to rebalance the portfolio very swiftly as it goes down. So there's a much greater chance of buying stocks at a cheaper price as it might have been last year, and so on and so forth. And historically, I've gone down more of the self-select route. and you don't, the speed with which you write to a client to explain the changes you want to make to the portfolio, for them to then sign up and say, yeah, okay, that's fine, make those changes. I mean, it's probably, it takes a month to get any changes made, even with a fast acting client.
Mm.
And absolutely, it's a great benefit. Rebalancing the portfolio, switching out poor performing funds swiftly, I think, is a huge benefit to clients that's possibly not always noticed by them.
Mm. I think ultimately that's why there isn't that many downsides to using a discretionary portfolio. I think most of the downsides come to cost and minimum. So a lot of discretionary managers won't take you on as a client unless you meet a certain level of assets. They've been coming down over time, but particularly some of the big institutions or actually clients that used to be looked after by their bank or private banking, the private banks have really ratcheted up the minimums for them to get involved. I think if you're at say some of the big banks down in London, say Citibank or Goldman Sachs, I think Goldman Sachs is a 5 million minimum, 10 million minimum, and to have that full discretionary process. So minimums are a key thing, and then costs are the other. Actually, some of those, for it to be competitive, you kind of have to be at those kind of levels to get a fair costing from those DFMs, and a lot of DFMs bespoke price. So if you're going to sometimes if I name names, those DFMs might not be too pleased with me, but some will give discounts depending on what the case is. So it can be a bit unfair in places, and actually going through an advisor to see a DFM is often better in that respect, because we can use our sort of bulk purchasing ability to be able to do that. And often those costs don't always deliver better performance. And some advisory businesses do really well and run really good portfolios, but it is an administrative burden, and it sometimes allows us to be more bespoke, or if there's certain client needs, advisory is good. But I think you're right, for all the reasons we've talked about before, discretionary is probably the way to go, unless you're using simpler strategies. I think that's the other thing. Sometimes it can be a bit more complicated or feel more complicated, but complicated is fine if someone's handling all that complication for you, ultimately at the end of the day. But I think the good thing is a lot of those downsides I've mentioned, the way we deal with clients or discretionary managers, we don't have minimums, and we have very cost-effective ways to access those discretionary portfolios. So yeah, there's very few downsides these days, but I think the alternative.
The obvious downside is there's another layer of cost, and so you need to ensure that your discretionary manager is making those gains both through the simplicity of portfolio maintenance and also the additional growth that they provide, in order for it to be worthwhile paying that extra bit of money for them. But I suppose also, being a DFM, they get some fund discounts for the amount of money that they hold with certain funds.
Yeah, and you can always be a race to the bottom in terms of costs, and like Tim was saying, the DIY investor and doing it all yourself. And it's the amount of times I've seen very intelligent people who've run their own investments make somewhat interesting investment ideas or concepts. I think when you outsource it, you also outsource a lot of the emotion of making the trade and everything else. And okay, they obviously have emotions and they're making the trade, but that's the biggest reason DIY investors go wrong. It's very easy to buy everything when all the ships are rising with the tide. But yeah, I think just having that area of expertise, or if you want to run some of your own investments, that's fine, but maybe, I don't know, hedge your bets and get someone to employ a strategy that's maybe counterproductive to yours. Diversification is always the key, and that's where different DFMs, they've all got their own specialities, and actually picking one that is right for you is easier said than done. But yeah, there's some good
experts out there and worth paying the money for.
Excellent. Well, there we go. That's why we do it here at EP. Use the DFM. So we'll leave it. I think we'll leave it there unless you guys have got any more to add. But hopefully that was useful and informative and gives you a slightly better understanding of why we use the DFMs that we use. And I think next week we're going to talk a little bit more about investment strategies, some of which will be employed by the discretionary investment managers that we use, and some perhaps that aren't. Anyway, more about that next week. Until then, goodbye.